Welcome back to Doc Tickers. This is this show for, the professional investor, the analyst, anyone who isn't satisfied just reading the headlines.
Right. We don't just skim the press release here.
No, we rip open the machinery to see how it's all actually working. If you want the earnings call completely digested, analyzed, and delivered with the real edge, you are in the right place.
It's good to be back. And today, we are going deep, just a single ticker, one that's been, a complete battleground stock for what feels like a decade now.
We are talking RKU.
That's the one.
Specifically, we're breaking down their Q4 2025 and the full fiscal year 2025 results. They hit the tape on the afternoon of February 12th, 2026.
And look, before we even get to the numbers, which are pretty wild.
They are.
We have to set the scene. The mood going into this thing was tense.
Tense is a good word. I even say anxious. Anxious might be putting it charitably.
I think so. The stock was just sitting there right around $83 at the close. And the sentiment was just fearful. You had this Walmart-Vizio merger looming over everything like a dark cloud.
For over a year, that's been the story.
A whole year. Plus, you had all these worries about the ad market slowing down. The stock itself had drifted, 20% down in the month leading up to the print?
Yeah, about that. The market was basically daring Roku to fail. The narrative was simple. The big guys are coming, and they're going to crush you.
And then the numbers hit.
And the stock didn't just, tick up a little. It ripped.
It really did. We saw it move to $91, $92 in the after-hours session.
That's a 10, maybe 12% pop in minutes.
So clearly the market liked what it heard. But here's my question to kick us off. Was this just a relief rally? Phew, they didn't completely implode, or did something fundamentally change in the business this quarter?
Because we've seen those relief rallies fade. They can disappear overnight.
That is the perfect question. And the answer, I think, is the hook for this whole deep dive. This was not just a beat. This was a pivot, a full-on profitability pivot. For years, the big knock on Roku, the reason so many value investors wouldn't even touch it, was that growth at all costs mindset.
Burn cash, get the households, we'll worry about margins later.
Exactly. That was the playbook. And what we saw in Q4 2025 was the death of that narrative. I think we are witnessing the birth of Roku as a cash flow machine.
Cash flow machine is a very bold claim. This is a company that was lighting money on fire not that long ago.
I know, but the numbers are there.
Okay, so here's the roadmap for today. We're going to scrutinize that claim. We will break down the headline beat, which was, frankly, massive. We'll get into the so-called monetization inflection.
Which is just corporate speak for how they're actually making money now.
Right. Then we'll dissect their defense against the Walmart threat, look at the AI tailwind everyone's talking about, and then you have to stick around for the end. We've got our not financial advice segment.
And I have a pair trade idea. It's a little wild, but I think it makes a ton of sense after this call.
All right, let's do it. Let's start with the snapshot, the headlines. Because usually a company beats by, a penny? Maybe two?
Yeah, it's a game, right? They manage expectations down so they can just step over the bar. This wasn't that.
No.
This was a demolition of expectations.
So let's start with the EPS. GAAP diluted earnings per share. It came in at 53 cents.
53 cents. Now, you have to remember, the consensus on the street, the so-called smart money, they were looking for 28 cents.
28, so that's a 25-cent beat.
They didn't just step over the bar, they pole vaulted over it. And we have to be really clear here, because a lot of the time with tech, you see these huge beats, but it's some adjusted non-GAAP number.
Right, where they've stripped out all the bad stuff, stock-based comp, restructuring.
All of it. This was GAAP EPS. Generally accepted accounting principles, real actual profit, the kind that ends up on the balance sheet.
And the top line, the revenue, looked pretty healthy too. Sure. Total net revenue was $1.395 billion.
And the street was at 1.35, so a good $45 million beat there.
Okay, so that's 16% year-over-year growth. But let me push back a little. 16% is good, it's respectable, but it's not the hyper-growth we saw back in 2020 or 2021.
When everyone was stuck at home.
Exactly. Are the glory days of 30, 40% growth just over? Are we seeing a slowdown?
I'd call it a maturation. But you have to look at the composition of that revenue to really get the story. You have two big buckets, right? Player revenue and platform revenue.
Player revenue being the little sticks and dongles.
Right, which they sell at basically zero margin, sometimes even a negative margin. It's just a customer acquisition tool.
A loss leader.
Totally. But platform revenue, that's the ads, the subscriptions, that's the real engine. And that line item hit $1.224 billion. It was up 18%.
So the high margin part of the business is actually growing faster than the overall business.
Exactly. That's the mix shift you want to see. The quality of the revenue is getting better every quarter.
Okay, that makes sense. But let's talk about the bottom line, because this is what I think really moved the stock. Net income was $80.5 million. Positive.
Positive GAAP net income. A few years ago, we were looking at 9-figure losses every single quarter.
And what about adjusted EBITDA? I know, it's a controversial metric.
Charlie Munger hated it, called it bullshit earnings.
He did. But for a tech growth company, it's a useful proxy for cash generation.
And it was a record, $169.4 million for the quarter. But the number that really popped for me, the one that I think institutional models are scrambling to update, is free cash flow.
The cash register is finally actually ringing.
Loudly. Trailing 12-month free cash flow is now $483.6 million.
Wow.
That is nearly $500 million in cash generated in the last year. That's cash for acquisitions, for buybacks, for whatever they want.
And they gave guidance on that too, or at least the CFO, Dan Jetta, he dropped a pretty serious hint.
Oh, he dropped more than a hint. He put a marker down. But let's just cover the near-term guidance first.
Okay.
Q1 2026, they're guiding to $1.2 billion in revenue. But for the full fiscal year 2026, they're guiding to $5.5 billion in revenue, and this is the real kicker, $635 million in adjusted EBITDA.
$635 million, wait, that implies, what, over 50% year-over-year growth on EBITDA?
Over 50%. That is the definition of operating leverage. Revenue grows, call it 18%, but your profit grows 50%.
That's why the stock is up.
That's it. Investors are finally seeing that for every new dollar of sales that comes in, a huge chunk is falling straight to the bottom line. They are paying up for that profit plus platform story.
Okay, let's unpack this inflection point idea that management was hammering on the call. They said 2025 was the execution year, and 2026 is the year of scale and monetization inflection. What does that actually mean?
Well, it starts with cost discipline. But it's about discipline relative to growth. This is the boring stuff that actually makes investors rich.
Go on.
In 2025, their operating expenses, their OPEX, grew by only 3%.
3%, while revenue was growing.
16%. Think about that spread.
That's the jaw of the alligator, right? Opening wide.
It is. And specifically, Jetta called out that stock-based compensation, SBC, is trending down. That has been a huge thorn in the side of long-term investors.
Because it dilutes the existing shareholders.
Massively. Roku was notorious for just handing out huge stock grants. Seeing SBC come down is what makes that GAAP EPS number look so clean. They aren't just moving expenses from cash to stock, they're actually controlling the total cost.
And with all this cash coming in, they're not just letting it pile up on the balance sheet, they're doing buybacks.
$150 million in stock in Q4 alone. And they have another $250 million on the authorization.
But the question with tech buybacks is always the same. Is it a real return of capital, or are they just soaking up the shares they issue to employees?
It's a great question. And in this case, the key metric is dilution. Usually with a growth stock, you just accept 2 or 3% dilution a year. It's the cost of doing business.
Right.
Roku achieved near 0% dilution in Q4.
Wow.
That's a huge maturity signal. It tells the market, we're grown-ups now. We manage our share count. It means when you buy a share of this company, your piece of the pie isn't shrinking every quarter.
Okay, you mentioned earlier that the CFO dropped a bombshell about future cash flow. What was that target?
He said he sees a path to $1 billion in free cash flow by 2028.
$1 billion.
Or he added, potentially sooner.
$1 billion in FCF. That puts them in a completely different league of companies. That's S&P 500 type cash generation.
It does. And there's this nerdy accounting detail that actually makes that target very believable. They have over $1 billion in deferred tax assets.
Okay, slow down. Explain that. Why does a deferred tax asset from the past help me as an investor today?
It's simple, really. Because they lost so much money for so many years, they've built up this huge pile of losses.
Right.
They can use those past losses to offset future taxes. Think of it like a giant stack of get-out-of-taxes-free cards. It means that for years to come, when they report, say, $80 million in profit on their income statement.
They aren't actually cutting a check to the IRS for 20% of that.
Exactly. They get to keep almost all of it. So their profit converts to actual cash in the bank at an extremely high rate. That's rocket fuel for hitting that $1 billion FCF target.
So the ghosts of all those past losses are actually funding the profits of today. That's kind of poetic.
It really is.
Okay, so the financial bedrock is solid. We've got cost control, we have buybacks, tax assets. But a business can't just cut its way to greatness. You have to actually sell stuff. Let's pivot to the engine, the platform business.
This is the fun part. So platform revenue is growing 18%. The big fear, though, has always been about margins. As you shift from one kind of ad to another, programmatic, video, whatever, does that margin collapse?
Because the easier an ad is to buy, the thinking goes, the cheaper it is, and the lower the margin for the platform.
That's the theory. But the data says no. Platform gross margin was 52.8%, and they're guiding for 2026 to be between 51 and 52%. It's stable.
Rock solid, really.
As long as that number starts with a 5, Wall Street is happy. But the composition of that revenue is changing in a really interesting way. We're seeing a big strategic shift from brand advertising to performance advertising.
We should define that. Brand advertising is the classic TV spot, right? Drink Coke, it makes you happy. It's about vibes.
Vibes, awareness, long-term brand building. Performance advertising is click here to buy these shoes right now. It's about math. It's about immediate sales.
And for decades, TV was only for brand. You couldn't click your TV screen. You couldn't track if a Super Bowl ad made someone buy a truck that afternoon.
But the whole industry is moving to performance. Advertisers want to track their return on ad spend, their ROAS, instantly. They want the kind of attribution they get on Facebook or Google, but they want it on the 65-inch screen in the living room.
And Roku is leaning into that. But there was a fear about this, wasn't there? The fear was that performance ads, which often come from smaller businesses, would be cheap ads that would drag down their margins.
That was the assumption. The idea that a big ad from Coke pays way more than an ad from a local pizza place. But management completely debunked that on the call. They said explicitly, performance ads are not margin dilutive.
How is that even possible?
It's all about automation. A big brand ad campaign involves sales teams, client dinners, long negotiations. It's expensive to sell.
High touch.
Very. Performance ads are sold through software. It's automated. It's data-driven. So even if the price per ad is a little lower, the cost to sell that ad is basically zero, so the margin holds up.
And this ties into their self-serve platform, the Roku Ads Manager.
Think of it like Google Ads or the Facebook Ads Manager, but for TV. This is aimed squarely at small and medium businesses, SMBs.
This is a huge expansion of their market then.
Total addressable market expansion, exactly. Before, if you were, a local brewery or a direct-to-consumer brand, you couldn't afford a TV ad buy. You'd call a sales rep, and they wouldn't talk to you for less than 50 grand.
Right.
Now you can just log in, swipe a credit card, and run ads on TV just like you do on Instagram.
And this is where the AI story actually becomes real, not just a buzzword. Because even if I can afford to buy the ad space, I still need a video ad, don't I?
That's the creative barrier.
Yeah,
exactly. A small business can't afford a production crew and a big shoot. So Roku is using AI to automate the ad creation. You can upload a few product photos, your logo, and the AI generates a professional-looking video creative for you.
With motion, music, a voiceover.
The whole thing, instantly.
Yeah.
That just blows the door wide open for millions of small businesses to become TV advertisers for the first time.
So you have the small guys coming in on one end, and on the other you have the big programmatic players. Let's talk about the third-party demand strategy.
This is what they call the open ecosystem shift. A few years ago, Roku was very protective. They wanted everyone using their own tool, OneView. It was a classic walled garden.
Right, keep it all in-house.
They've realized that to win, they have to be everywhere. They're opening up the pipes, deepening their integrations with the Trade Desk, with Google, Yahoo, everyone.
And the big one, the complicated one, Amazon.
The frenemy dynamic, they talked about it on the call. They're in the early innings of a partnership with Amazon's DSP.
This is so strange, though. Amazon competes directly with Roku with a Fire TV stick. They are fierce rivals in the hardware aisle.
They hate each other at Best Buy, for sure. But Amazon is also one of the biggest ad buyers in the world. They need to buy inventory on Roku to sell products on Amazon.com.
So it's just a pragmatic move. Money is green.
I see it as more than that. I see it as a validation of the platform's power. It proves Roku's audience is so large and so valuable that even your biggest hardware competitor cannot afford to ignore it. Amazon has to pay the toll to cross the Roku bridge.
Okay, so what about that experience for the audience? They mentioned a new home screen is in testing. As a user, I hate when they change the interface. But as an investor?
As an investor, you should be thrilled. This is the most valuable real estate in streaming. That home screen is the front door for half of America's broadband households.
And they're adding new ad units.
Marquee units on the right side. And this is the big one, video ads directly on the home screen.
I can already hear the complaints on Reddit. But if they can pull it off without ruining the experience, the monetization potential is enormous.
And don't forget Roku City. That screensaver has become this weirdly beloved cultural thing.
People actually watch it.
They do. It's featuring the Olympics right now. They're turning that into another monetization vehicle. It's brilliant because it's inventory that users actually like. It's not an interruption.
Okay, we have to talk about the elephant in the room, the strategic battle. Let's get into distribution, devices, and competition. Because for the last year, the bear case on Roku was dead simple.
It was. Walmart is buying Vizio.
And Walmart is the biggest TV retailer in the country.
So if Walmart owns Vizio, they'll just kick Roku TVs out of the store and only sell Vizio. Roku loses shelf space, Roku dies. That was the whole thesis.
And it really did weigh on the stock.
Yeah.
But management came out swinging on the call. Their counter is just aggressive diversification.
They basically said, fine, if Walmart doesn't want us, literally everyone else does. And they brought receipts.
They listed specific wins, right? They expanded with Best Buy, launching new Pioneer Roku TVs.
Expanded with Target, launching Roku's own branded TVs. And most importantly, they renewed and expanded their long-term deals with their biggest partners, TCL and Hisense.
So the diversification is real, but you mentioned something about a hardware edge that Anthony Wood, the CEO, talked about, something technical about the bill of materials.
Yes, the BOM cost. This is my favorite part of the call because it's so subtle but so powerful. He claimed they have the lowest BOM cost in the entire industry.
Okay, but why does the cost of a circuit board matter to me right now?
It matters because of where we are in the global hardware cycle. Memory prices, the cost of RAM, of storage chips are rising. This is a known commodity cycle. Now, think about the operating systems.
Okay.
Roku's OS was purpose-built from the ground up just for TV. It's incredibly lightweight. It can run on very cheap chips with very little memory.
As opposed to something like Google TV or Android TV.
Exactly. Android is a heavy OS. It was built for phones, which have powerful chips, and then it was sort of jammed onto a TV. It needs more processing power, and it needs a lot more memory to run smoothly.
So if you try to run Android on a cheap TV, it's laggy and it crashes.
It's a terrible experience. So as memory prices spike this year, the cost to build an Android TV or a Vizio TV goes up because they have to include those more expensive memory chips. The cost to build a Roku TV stays low.
Which puts the competitors in a huge bind. They either have to eat that cost and kill their margins, or they raise the price of the TV and lose sales.
While Roku can just hold the line on price, it's a widening competitive advantage. It's an engineering moat that Wall Street often ignores because they're too focused on ad rates.
And they're making their own TVs now, too.
Yep, and they just shifted that production to Mexico to lower costs even further. They are optimizing every single cent.
And all of this is leading to just massive scale. They dropped a huge milestone number.
They did. They're on track to surpass 100 million streaming households in 2026.
100 million. That's a staggering number.
It's half of all U.S. broadband households. Half of all TV streaming in the country happens on a Roku device. When you have that kind of scale, you're not a gadget anymore. You're infrastructure. You're a utility.
Okay, let's look at content and subscriptions. Ads are the big moneymaker, but subs are that nice, steady, recurring revenue.
And Q4 was their biggest quarter ever for premium subscription net ads.
What's driving that? Is it just more people signing up for Netflix through their Roku?
It's the great streaming consolidation. The thesis is that as all these services fight for survival, the smaller apps just can't make it on their own. They don't have the marketing budget to go out and acquire customers one by one.
So they need an aggregator, a distributor.
And Roku is becoming the default aggregator. They sell the subscription, they handle the billing, and they take a cut. It's the cable box of the future model.
You paid one bill to Roku, and Roku pays all the apps.
Precisely. And they're adding their own services to the mix. We have to talk about Friendly and Howdy.
Howdy? What in the world is Howdy?
It's their new service. Friendly, which is spelled F-R-N-D-L-Y, was an acquisition they closed last year. It's a bundle of family-friendly channels. Think Hallmark, the Weather Channel.
Wholesome stuff.
Exactly. Howdy is a new launch. These are their own owned and operated services. They drive revenue, sure, but more importantly, they drive engagement. And because Roku owns the OS, they can push these services right to the front of the home screen.
And it sounds like Friendly is already big enough to actually affect their Q1 revenue comparisons.
It is, which just shows how powerful that platform is. They can buy or build a service and instantly plug it into a massive user base to get scale.
One more thing on content. Anthony Wood was very bullish on generative AI.
He was. His take is that AI is going to significantly reduce the cost of producing content.
Which is an interesting bull case. A lot of people see AI as a disruptor or a threat. He's saying, no, cheaper content just means we get more content.
And Roku monetizes time spent. If there's more stuff to watch, people spend more time watching. Roku wins. For them, AI is a massive tailwind for engagement, not a threat to their business model.
Let's zoom out. The investor context for 2026. They guided Q1 growth at around 21%, but the full year at 18%. Why the slowdown in the back half of the year?
It's not really a slowdown. It's mostly about the comps, the comparisons to the previous year. Q1 of 2025 was a pretty weak quarter, so the year-over-year jump this year looks huge.
And the Friendly acquisition adds revenue in Q1 that wasn't there last year.
Right, but that laps in Q2, so it's more about the math than a change in the business momentum.
But there is a huge wild card for the second half of the year, right? Politics.
The political ad cycle. 2026 is a midterm election year. Political ad spending is always back half weighted. It floods in during September, October, November.
So management is probably being conservative with their guidance.
Very. They're not baking in a huge political windfall yet because the visibility is low. But if that political money comes in strong, and political ads almost always pay a premium,
they will blow past that 18% full-year guide. It feels like a classic beat and raise setup.
It does feel conservative. It feels like they're leaving themselves a lot of room to surprise to the upside later in the year.
Let's talk valuation and sentiment. The stock was down 20% going into this print. The fear was palpable.
The setup was pure fear. The payoff was pure relief. And you saw analysts moving right away. I think Seaport raised their target to $130.
And the whole conversation is changing. The new metric everyone is watching now is free cash flow per share.
It's a different narrative. Investors are finally looking at Roku as a cash generator, not just a revenue growth story. And that changes the kind of investor who owns the stock.
You get fewer momentum traders and more long-term compounder-type investors.
Which should, hopefully, stabilize the stock price and reduce some of that wild volatility.
Okay. We've covered the numbers, the strategy, the tech, the competition. It's time.
Let's do it.
This is not financial advice.
And we have to say it. Standard disclaimer, we are just two voices on a recording. We are not your financial advisors. We don't know your portfolio. We don't know your risk tolerance.
Please do your own due diligence. Don't call us if you lose your shirt.
Please don't.
But if we were in a room pitching an internal investment committee on a high-risk, high-reward idea based only on this call, what's the trade?
I've got one. I'm calling it the memory crunch pair trade.
Ooh, I like the sound of that. Break it down for me.
Okay, so the setup is that hardware dynamic we talked about earlier. Anthony Wood explicitly flagged that rising memory prices are a massive cost pressure for the entire industry.
But Roku has the lowest memory footprint. That's the core of the thesis.
That's the fact it's built on. So the trade is simple. Long RKU, short Vizio.
Or if shorting Vizio is tricky because of the merger situation.
Then you short a basket of other heavy OS TV makers, or even a consumer electronics ETF that's going to be sensitive to those rising component costs.
Walk me through the logic one last time. Connect the dots.
As memory costs spike through 2026, competitors like Vizio, especially under pressure from Walmart to keep prices low, are going to get their margins squeezed. They either have to eat the cost, which crushes their earnings, or they raise prices and lose sales.
And Roku, with its super efficient OS, can just hold prices steady.
And steal market share at the low and middle end of the TV market. You're basically leveraging Roku's operational efficiency alpha against the hardware commodity beta of its competitors. You are betting that Roku's code is worth more than Vizio's silicon.
That is a sharp trade. It's betting on the engineering advantage turning into financial dominance. Do you have a kicker idea?
I do. A slightly different way to play this. The 100 million household breakout call.
And how do we play that one?
You buy slightly out of the money LEPS. That's long-term equity anticipation securities. specifically calls expiring in January of 2027.
And the catalyst is just that milestone.
It's a psychological break. When that headline crosses the wire later this year, Roku surpasses 100 million households. At the same time, the narrative about them generating $1 billion in cash flow is taking hold. I think the multiple on the stock expands. You want to be holding those options before that headline hits.
I love that. High risk, but a very clear catalyst with fundamental backing. That is exactly what this segment is for.
That's how we like it.
All right, let's wrap this thing up. Give us the final thesis in a nutshell.
Roku delivered the profit pivot, period. Revenue beat, record EBITDA, clean GAAP income. They proved the fear of Walmart was overblown by diversifying. They proved the ad spend fears were overblown by shifting to performance and SMBs.
And the cash is flowing, the buybacks are real, the dilution is gone.
Exactly. They've turned the corner from a growth story to a profit story.
This was Talk Tickers covering the Roku Q4 2025 earnings. The stock is moving, the cash is flowing. We'll catch you on the next print.
See you next time.